Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Ogti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
In this episode, Aaron and Trishul discuss the value of a financial advisor and the impact that financial planning can have on the lives of clients. A disciplined investment strategy and increased savings over time can lead to a higher net worth for clients than if left to their own devices. Also, advisors help clients find small but meaningful opportunities while avoiding seemingly small mistakes that can compound over decades. Beyond the dollars, clients consistently express that the trust and peace of mind from knowing someone is taking care of all the little things reduces their stress and improves their overall well-being. And now, on to our conversation.
Hi, my name is Aaron Ogti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey Aaron, great to be here today, and thanks everybody for listening.
Great to be here as well. Today, we're going to be talking about the value of a financial advisor. This is a common question we get from anyone who's looking for an advisor for the first time. Just what am I getting for what I'm paying for? And I'd like to start off with an anecdote of a story that I've shared, and it's from a good friend who's also a client, and he's also a data scientist. It's kind of a half-joking story. I was trying to say that, well, there are pretty good studies that anyone or any household that's working with a financial advisor has a greater net worth than those without. And I told it to him because he's a data scientist, he kind of got the joke that there's a causation correlation issue there, that the study does not look at did they have the money before hiring the advisor, or did the advisor help them grow their net worth? And it's worth looking into that because there aren't really good studies about that. There aren't really good studies that could separate that causation correlation. And that's what most people are wondering is, could I do the same things without an advisor and save the money on fees, or is there greater value for what I'm paying? And over the years, I've had similar conversations with him. I've very open relationship, and I always try to ask his input on how he sees our relationship. And it took him a while, but he was able to start to identify that even though I had saved him money on taxes and helped him understand laws related to Roth conversions and recharacterizations and kind of fixing some of the mistakes that he had made, he understood that there was kind of enough value just in terms of dollar and cents to make up for the fees he was paying. But he and his wife felt that it was the conversations about their life and their goals that provided more value, that there was a sense of peace of mind and confidence that they were making the right decisions. They didn't have to worry about things. And that was his kind of big overarching take, that he loved working with a financial advisor because his life was easier, his life was better. He knew he was making the right decisions. His net worth was growing faster than others his similar age and income. So he was starting to see those tangible benefits, but it was really the intangible benefits of being able to sleep at night, knowing he was making the right decisions for his life, that he truly valued. And we're going to try and unpack this today. Some of the tangible benefits of working with an advisor, some of the intangible benefits, some of the questions regarding how to plan around life and how things change, what are the differences between some advisors that you might be able to read about. But we're going to kind of explore this very nebulous topic of what is the value of a financial advisor. So, Trishul, when you first hear that, or you have someone ask you that, when you think about financial planning or hiring a financial advisor, what is the first thing that comes to mind in terms of the value that an advisor provides?
I like that story, Aaron, and I definitely have some thoughts of other anecdotes where the value comes up. But before we dig into that, at a high level, what comes to my mind is the fact that in this industry of financial advice or just seeking advice, not all advice is created equal. Meaning that there are advice that comes in many flavors and colors, and it's kind of important to understand if you're paying for advice or you're hoping to get advice with money attached to it, how that can happen within the industry. So in the past, a common channel for advice was basically you called up your stockbroker and you said, hey, I'm looking to do some things, or I need to come up with some way to allocate this capital and I want to put it to work for me. Well, what do you suggest? And this individual you would call your stockbroker, known as an individual or an agent of a broker dealer, might suggest to you a bunch of products that might make sense, either stocks or mutual funds, things like that, that might fit what you're looking for. So from some perspectives, this might be considered some kind of financial advice that's kind of incidental to the stockbroker selling you these products. But something to realize is how this actual broker is incentivized. There's commissions. You're not paying the broker a fixed fee, but the broker is earning a commission for the products that they sell you. Well, another flavor of advice is coming to another type of individual known as a registered investment advisor. And, for disclosure purposes, that's where Aaron and I are. And when we think of registered investment advisors, these are financial planners or financial advisors who are in the business of providing advice to clients. Now, there are two things to consider with registered investment advisors or their representatives. One is there's this category of advisors who may still provide advice, but also earn commissions. And they may charge a fee and earn commissions on products that they sell. And that's certainly a business model that's common and out there. But then there is another subset of financial advisors who will not earn commissions. They say that they would not like to earn commissions, but they would like to earn all of their fees directly from the clients. So the former is known as a fee-based advisor, and the latter is a fee-only advisor. Now, why would somebody care about this? And from one perspective, an individual who is fee only might choose this path to lower the chance of having a conflict of interest. And here's an example of where this may come up. Just as an anecdote, let's say you want to visit a doctor and you're scouting around and you find two doctors that fit what you're looking for. So Dr. A says, I can help you out, but by the way, for every pill that I give you, I get a kickback from the pharmaceutical company of my choice. Whereas Dr. B says, I can help you too, but I don't believe in kickbacks for giving pills because it might compromise my duty to serve you as best I can. And that's what you might see with a fee-only advisor who doesn't want to take commissions versus a fee-based advisor who may take commissions. So if you have the choice, some people might say, yeah, I want to go with a doctor who doesn't take kickbacks from pharmaceutical companies. Not that that's allowed, but in the financial industry, you want to be aware of who and what is being compensated. So that's what I'd say in terms of advice in general. So I happen to be fee-only. Aaron, you are as well.
Mm-hmm.
And I think we chose this path for similar reasons in terms of helping us understand that we want to put the clients ahead of our own best interests. And in fact, that's what it does mean to be a registered investment advisor. We are fiduciaries by regulation and by choice as well, as we want to operate in this business, but also because that's what we feel is important. And when we say we're a fiduciary, that basically means that we're required to put our clients' interests ahead of our own. It's the highest standard that we can have. So at a high level, when we think about the value of advice, we want to understand there's many different types of advice, and you probably want to choose an advice stream that aligns with your best interests. So that's the first thing I'd probably say.
Okay, so you're saying that if someone is looking at kind of what is the value of a financial advisor, it actually is important to understand the compensation structure, like how that advisor is paid and what incentives or conflicts may exist that could impact the value of that advice.
Right. And I think the biggest thing that I kind of latch onto in my mind, if I'm seeking advice, is I kind of wonder, well, if somebody's earning a commission for a product they're selling me, how incentivized are they to give me the product that's best for me, such that that commission doesn't weigh in, such that I'm not paying more in commissions just because it rewards that person selling me a product. And that's something I'm sensitive to, and I'm sure that many of my clients are as well.
So this reminds me of an analogy that when looking at financial advisors and kind of understanding the evolution, a generation ago, having a stockbroker was genuinely valuable because you couldn't go online and buy stocks yourself. And there were, even going back farther, earlier in the century, earlier in the last century, there was significant fraud issues of people wanting to buy stocks, buy equities, and they would buy stocks in companies that didn't exist. So that was the first level of regulation, was just making sure that these companies existed and that you could trust that the person helping you buy the stocks in those companies was what's called a registered representative of a broker dealer. They are following certain regulations to make sure that they are only offering legitimate companies. And as the evolution of the industry grew, they did kind of realize that there is an incentive for those stockbrokers to recommend new stocks because, again, they got paid on that transaction. And there was a financial incentive for them to say, oh, I recommended this stock to you last year, but we're going to sell out of that one and buy this new stock because they get paid on both the sale and the buy. And this can create an issue of churning, that there were kind of too many advisors recommending selling and buying stocks just for the purpose of generating those commissions. It's a little similar to life insurance, where every person who sells life insurance gets paid more based on how much life insurance you buy. That if you were to buy $1 million policy, regardless of what type, it will pay more than the same type of a $500,000 policy because it costs the client more. And so a portion of that premium goes to the person who sold it. So there was always this incentive to do a little bit more. Like you said, even if it wasn't truly appropriate for the client, that incentive and that potential conflict existed. And the analogy I've seen for this evolution is looking at buying a car, where if you imagine a generation ago or even older, so much of buying a car was opening up the hood and looking at the engine. Like, do all the moving parts work? And you don't want to get a car that'll break down. You don't want to get a car that's old and rusty. But now, if you buy a car, there's a general assumption that the engine will work. We have different sources like a Carfax report or the dealer, and most people buying a car will assume that the engine works. They'll take it for a test drive, but they're choosing the car based on all the features, based on the seats, based on the air conditioning, based on the backup camera. They're choosing the car based on all the things they want to fit their life. And that is what financial advice and financial planning has moved to, is kind of tailoring the recommendations to the individual based on the life that they want. And I think this is an aspect where a registered investment advisor acting in a fiduciary capacity does provide, or is more likely to provide, unconflicted advice that is truly in your best interest, because they are learning about your life and generally care about your life because you're the person paying them. And if the client isn't happy, then they can go find another advisor. So it's no longer the nuts and bolts of how the investments work and how I'm putting together that stock and bond portfolio. While that's still important, you have to make sure the engine works. You choose the car based on your lifestyle, how you're going to use it, and how you like driving it, just like you choose an advisor based on your lifestyle, how you like communicating with them, and do they make your life better? So I do think it's important that it's not that stockbrokers are bad and registered investment advisors are good. It's understanding where the evolution was, where they had a really important role a generation ago. And now buying stocks from a stockbroker because you can go online and do it yourself doesn't make that much sense. There has to be some other value that the advisor is providing. And that's where financial planning provided by RIAs, registered investment advisors, tends to make sense moving forward. That you know what lifestyle you want and you want someone who can help you achieve that lifestyle. And the investments, sometimes, and a lot of times, the stockbroker wasn't outperforming a benchmark anyways. So you can get the investments to match market returns and maybe have a conversation about active versus passive, but the value is in the financial planning side, not just the nuts and bolts of the investments. So Trisha, when you think about kind of the evolution of financial advice to where we are now, what are some other things to be aware of among the different types of financial advisors?
I think you made some really good distinctions. So I'd certainly like to build on a few things that you said, Aaron. We talked about the evolution. In the past, there was a good amount of actively trading, meaning you call up a broker, they give you something to think about, and if you like it, you invest in it. And then a little while later, your broker may call you about something new and hot and so on, which, as we mentioned, there has been a tendency to do a lot of trading in the past. But closer to our generation or the next generation, there's this notion of having a more passive strategy, investing in indices and not having a lot of turnover. And what's actually been studied academically is the notion that there are considerable differences between these two styles of investing that can provide a quite substantiated difference in value to clients as far as returns go. So, for example, this was studied by two academics, Brad Barber and Terence Odian. We've probably mentioned these academics before, but
It's actually
they've done some
Terence
research.
O'Dean.
Odine.
I've met him at a conference once.
Yeah, so Terence Odine and Barber have written many papers, but the one I want to highlight is one of their works in the 90s called Trading is Hazardous to Your Wealth. And I guess the title kind of sums it up, but the notion is that the more individuals trade, the lower their performance on a net return basis after you compensate for trading costs, fees, and commissions and things like that. And the differential is quite substantial. They looked at research of individual investors' behavior, and they kind of grouped them into buckets in terms of the people who traded the most and the people who traded the least. And there was a pretty stark distinction between the two groups' performance. In fact, the people who traded the most, the people who jumped on every new idea from either their broker or for whatever they researched themselves, they ended up doing less by about 7 percentage points a year, 7% a year, than the people who traded the least after you compensate for fees and commissions and trading costs. Now, we talked about the long-term market expectation one might expect from investing in stocks, and that is about 7%. So you can see how that's a pretty big difference. And I think that points to a stark value that a financial advisor can have that's on your team, meaning if they can pull you into a notion of trading a lot less frequently, that can provide a good amount of value over someone's investment lifetime. The other thing that they noted in this particular paper is that if you just look at the average individual, compared to somebody just passively invested in the S&P, the average individual did worse by about 1.5% a year. So an advisor, I would hope, help make up that difference by providing advice that might lean somebody more towards that passive portfolio rather than the average individual who tends to be more active. So I think that's a good amount of benefit that a financial advisor could bring to the table. That's what I try to do with my clients. I try to encourage less trading and longer holding times, and the focus not on trying to outsmart the market, but try to ride the market. And the last point I want to make on this particular point is I just crunched some numbers some time ago just to see what this 1.5% difference could make over a long period of time through the value of compounding, because it doesn't sound like a lot, but it can actually be quite substantial. So I just ran some numbers looking at the S&P over a 45-year period, and say in the late 70s, somebody put $10,000 to work in the S&P. Well, after about 45 years, that 10,000 would have grown from 1974 to 2018 when I had done this study to almost $1 million. The market had a pretty good run over that period, around 11%, which is higher than one might expect, but it's the market. It can do well if you let it do its job. So 10,000 can go to around 970,000. But if you gave up that 1.5% a year, like the average investor does, who decides to manage their own money, instead of being left with close to $1 million, you'd be left with less than $500,000. So you'd be giving up half of your upside just by doing all of this shuffling. And that's pretty substantial. That could mean the difference between retiring at 50 versus 60 or 60 versus 70. And that's just one $10,000 investment. I'm sure individuals will make many, many, many $10,000 investments over their lifetime. So it's just something to think about, where the value of a financial advisor on the investment side can be quite substantial just by providing this notion that there is a sensible way to invest that can increase your probability of having a good return while decreasing the probability of paying these excess fees and trading and commissions and turnover, and then of course taxes.
So you're saying that kind of the first level of value that an advisor provides is helping maintain a disciplined investment strategy with emphasis on the discipline.
For sure.
So I'd like to, I don't know if you can try to identify that specifically, because I imagine there are a lot of people who say, oh, I can choose a Betterment or Wealthfront or just a Vanguard fund, and I can leave it alone. I don't have to react. I've read enough things. So is that enough to make up for what an advisor would charge, or should I just do it myself? And I do wonder if that's possible, or if is it a people can't see their own biases.
I think it comes down to a few things. I think it may be necessary, but it certainly isn't sufficient. So there's a lot more that goes into it than just putting that money to work, because there are these biases that come into effect. For example, we've talked about many of them where there's this notion of overconfidence, where individuals may be tempted to try to time the market here and there. They might get nervous about a certain situation. For example, coronavirus, we talked about examples about earlier in the year. I've seen instances where clients wanted to go to cash, and at the worst possible time, which we quickly learned just 2 months later, would have let them down in a hole that might take them decades to recover from. So it's certainly part of that coaching that can happen throughout the life cycle of an investment. But in addition to that, there's also efficient ways to put money to work. We talked about the notion that there are these tax advantage accounts that you want to be aware of, and the rules are constantly changing, but you want to be aware of where you want to put the money so that it's matched with your investment horizon. Also, understanding your risk tolerance is important, and not everybody has an intuitive understanding of what that is until they're under the gun and they make a mistake. So this is part of a structured process that we try to bring to the table. The notion that first we want to understand risk, we want to understand tolerances, we want to match durations of investment horizons. So I think, just the simple put in the S&P and kind of hope for the best is something that may be a necessary thing to do for some people, but it may not be sufficient to provide them with enough substance to be able to sustain everything that you need to have a sensible plan for one's retirement goals or the short-term goals or whatever they're planning to do in terms of their life objectives.
So I like that. I want to go a little deeper on that. That when I talk to clients or prospective clients, I try to tell them in as nice a way as possible that while that one extra 1.5% that is possible, they could do that without an advisor. In studies, that is part of the reason why those who work with an advisor tend to have greater net worths than those who don't. Even if you tried to account for they started at the same time with the same amount of money, that's one of the small reasons why the net worth is growing. Is that disciplined investment strategy, also kind of keep an eye on taxes, both taxes related to the investments, but also the taxable accounts versus retirement accounts. So I do like those points. The other really big benefit that directly impacts net worth that I've seen is an advisor does a really good job of pushing clients to increase savings over time. And this gets to the other part of potentially where that greater net worth could come from is, let's say they were saving $10,000, that we don't know if that's enough for them to reach their goals. Maybe they need to save $11,000 or $12,000. And for my clients, one of the things I've specifically done is we start off at a certain savings amount based on their lifestyle and cash flow. But each year, I'm pushing them to increase their savings. And within a few years, these clients were both husband and wife maxing out their 401ks. And this, if I had to pick something, was the biggest reason why their net worth was greater than other people of the same age and or income, was that consistent increased savings over time. That 1.5%, they haven't been clients long enough to really see the benefit of that. It's going to take another decade or two. But the increased savings is directly impacting their lifestyle. And it's one of those things that while it's not necessarily technically difficult to understand that, the rules for retirement plans are pretty clear if you talk to HR or look up just kind of very basic Google searches. But those I've seen who are not working with an advisor, they end up having lower savings rates. They tend not to increase their savings rate over time. It's this kind of combination of numerous missed opportunities that it's hard to quantify in any study of this person working with the advisor made the right decision, and this person waited a year or two before starting their Roth IRA. They waited just a little bit longer to increase their 401k contribution above 6%. That was getting the company match. And so now they're saving 8%, whereas someone working with an advisor is already saving 10 or 12%. So I'm trying to think of other factors that might go into that are quantifiable if possible, but could just be qualitative. That kind of a good disciplined investment strategy helps them make as much as an extra 1.5% per year. Consistent increased savings is another direct impact that working advisor helps. What are some of the things that come to mind, Trishul, for you that clients could expect that they might not do themselves if left to their own devices?
Right. You made some very good points. And I think the way I kind of fit it in my head is they fall under two broad categories of advice. The first deals with the investments in terms of you have the money, but how do you efficiently put it to work? So investment management deals with issues surrounding, are you paying sensible fees for the products you're invested in? Do they match your risk tolerance and your investment horizons? Is your assets allocated appropriately? I prefer a globally diversified portfolio where possible. And are you rebalancing at a schedule that makes sense? And are you taking appropriate measures to take advantage of tax loss harvesting and things like that? So these are all things that are sensible, that are just beyond investing in the S&P, for example, that a lot of people may not be doing because maybe that they're not holding themselves accountable to these items, but they can make a good amount of difference over time. And from the investment side, again, we've mentioned that a little change, maybe a percent or two here and there doesn't sound like much, but over an investment lifetime, this amount can be substantial and well pay for, the fees you might incur for advice in this area. But the second category is also important. In addition to investment management, where you're deciding how to allocate your money, there comes the whole financial planning aspect of how do you get that money first to begin with, and how do you put it in the right buckets. So with financial planning, there are many categories of advice here that are likely helpful for a given client, where you might be interested in better understanding what to do about your retirement, or saving for college, or handling your estate plan, or coming up with a solution for your budgeting and cash flow needs and things like that. So in all of these areas, having a sensible plan is something that can help you. And there are a lot of ways where individuals can get tripped up, where having a good advisor can help overcome some of these issues. I think it falls into a few categories that you kind of mentioned. Often there are just issues where an individual is planning too little and too late, meaning the earlier you plan for things, the easier it will be to obtain your goals. If you're not saving for retirement until you're in your 50s, then it's going to be a lot harder than if you started a decade or two earlier, just because you missed out on that benefit of compounding for 10, 20 years. It makes a big difference. And then there's just categories of mistakes, like, whoops, I rolled over my account but forgot to handle XYZ deduction and something like that, where that can be costly. Just waiting too long to get advice means, similar to how if somebody has a problem that's health related and they're proactive about it, instead of it being stage 4 cancer, it could have been stage 1. Things like that are important from a financial standpoint as well, because time can be your enemy if you don't let it work for you.
Yeah, I do. Now that you say that, I do think about that fairly often, where there are a lot of little mistakes that people would make without realizing it, without talking to a professional. One of the things that comes up is what's called net unrealized appreciation. Basically, if you have company stock inside your 401k, there's ways that you can pay taxes at long-term capital gains rates instead of ordinary income rates, but it has to be done when you roll over the 401k to an IRA. Like, you only get one chance to make that decision, right? And for a lot of people, if they don't work with an advisor, they don't do it, they're not hurt that badly because they still have the money. But the chance to reduce the taxes on that money by 5 to 20%, that's just one of those little decisions that could save them a few $1,000s when they do their 401k rollover. And there are so many of those little things, like I had a client who accidentally contributed to a Roth IRA even though he and his wife made too much money. So we had to undo that Roth IRA contribution, and we had to make sure we calculated what's called the earnings attributable to the Roth contribution and take that out as well. And so it saves them a 6% penalty on that money by making sure the calculation is correct. And just finds all these little mistakes that add up over time that by talking to me, I make sure that they avoid them. And I do wonder how many people are making these little mistakes because they're not talking to an advisor. Do you have any other little examples you can think of that you've seen working with clients of just things that are easy to overlook without realizing it?
There's certainly more than you can count. I think we've probably already talked about a dozen of them over the course of the episodes that we put out there. But before I dig into a few specifics, in my mind, I've always thought about this from this analogy where I imagine an individual who follows all of the rules. He or she invests exactly how they should, puts the money in the right retirement accounts, and saves the amount that is sensible for their income, and takes advantage of all the different tax nuances out there and all of the savings plans and the employer sponsored plans and the estate plans and whatnot. And I compare that to the average individual who constantly kind of misses these little things which are helpful. And in my mind, I just think if you run that perfect game of just doing everything you're supposed to do, I feel like that can take years, if not decades, off the amount of time you might need to work, just because you're taking advantage of everything you need to and you're letting your money work as efficiently as possible. Whereas if you follow the standard approach of saying, oops, I missed that 401k contribution for the last few years because it was, an opt-in plan, not an opt-out plan, or whoops, I thought I was over the income limit for investing in my Roth and I just forgot and didn't bother to get some money in there. And, I wanted to trade a little bit, but I got worried. So I pulled out at the wrong time. And you just add all this up. And I feel like it just detracts so much from where somebody may be if they followed what they're supposed to do. And frankly, it's hard to do. It's hard to follow all of the things you're supposed to do and keep on top of it. The tax code is, by my count, 3,670,000 pages. So there's that alone, and then just all the nuances you have to do to decipher what makes sense for your specific situation. It's hard, and it's hard to even hold yourself accountable. And we've heard even these stories of how advisors put their own interests at the bottom of the table of their clients just because it's hard to give yourself priority when you're worrying about everybody else's as far as how clients go. It's the notion that being accountable is difficult, and that's why people do reach out for support in some of these things, especially when it comes to complicated scenarios as managing one's own money and planning for big life decisions.
I think that's the biggest general takeaway I get from clients. It's that peace of mind aspect that they're not worried that they're making the wrong decision and they know someone's looking out for them. That's one of the things I consistently hear from clients, that we've been putting together a plan, markets go up, markets go down. They don't worry about that. It doesn't faze them. They feel, they can genuinely feel their life is better and more enjoyable. There's less stress, less anxiety, because they know that I'm looking out for them. Sometimes they come to me with these big questions, especially when it comes to stock options. And it's kind of, if we do this right, we're saving you literally hundreds of thousands of dollars in taxes. And if you do it wrong, you're going to pay that much more. So sometimes they do come with those big questions, but over the years, the big satisfaction comes from just knowing Aaron's taking care of them, knowing Trishul has their back, knowing that they don't have to worry about this little thing. I get so many emails from clients that my HR send this to me. Do I need to do anything? And I respond with, nope, I've read it. I've looked at the 401k fund change that's happening. You don't need to worry about it. The default process is going to work. And sometimes like, oh no, you need to do this step. Please, here are the specific instruction things you need to do. Because it is things like, is the 401k an opt-in versus an opt-out? Do they start the first day or they wait a few months before you get around it? Is the how much they're saving in the 401k at the beginning is a factor. Is the default investment option, is it cash or is it a lifestyle fund or a target fund, which already might be more conservative than they really want to be. They might want to be more aggressive. So all these little defaults that are just too easy to fall into, advisors help make sure that they're not getting stuck with those defaults, that they actually are making those decisions. And I keep hearing that they thank me for keeping them accountable, for making sure that the right thing gets done at the right time, that they don't have to worry. And it's hard to quantify that. And I'm curious, have you had similar conversations with clients or observations over the years of the kind of intangible benefits outweighing the tangible benefits?
I certainly think so. And I think peace of mind, as you said, it plays a big part into it. The other thing that weighs in on my mind is the notion that, yeah, that there's a benefit from dollars saved or more dollars invested or higher returns potentially. And there's also peace of mind, but also that there's this notion of having somebody that can help you focus on things that are not entirely financial in terms of what does a client actually want to do with their life.
Mm.
That's a question that often doesn't get asked at all in one's course of daily affairs. Have you actually thought about what you want this money to do, or beyond that, what goals you have in life that aren't purely financially motivated? And let's see if we can work through those by using your money the best way you can so that you can live your best life.
Absolutely, absolutely. That's the big thing that I've been helping my clients with, especially over the last couple of years as I've furthered my training on life planning. And we've talked about Kinder's 3 questions in a past episode, but it really is that, what is the lifestyle that you want? Here's what you're on track for. Is that what you want? Or is there something else that you want to achieve in life? And if so, if this is kind of more important, what are the intentional decisions, the conscious steps we need to make sure that we're on track for that? Because so many people are just, they're kind of on autopilot, on track to retire at 65. And because that's when Medicare starts and they're going to save enough, and then they only need a 35-year retirement or maybe even less if it's depending on health. So a 4 to 5% withdrawal rate is fine, and they'll get some Social Security. But there's this opportunity to do so much more. For some people, it is being financially independent before they're 60. For some people, it is traveling the world. For some people, it's changing careers in their 40s to find the career that they would love to do into their 70s. But there's so many of these little things, and also some of these big scary things, that having an advisor to talk to and help flesh out and identify these goals has had that incredible impact in my clients' lives.
Very good point. So I think overall that there's plenty of tangible or quantifiable benefits. And it's really when you layer in these more fuzzy, less quantifiable benefits that you get a pretty good picture of how having this type of guidance can be sensible for an individual over the course of their lifetime, including when they're young and just starting a career, or when they're kind of building their career and family, and also when they're nearing retirement and beyond.
Yeah. If someone asked me kind of what should they look for in a financial advisor, there are definitely some, like the CFP, Certified Financial Planner, is a really good indicator of technical planning ability. The compensation structure matters. I'm not saying one is evil, one is righteous, but definitely understanding how your advisor gets paid matters. But a lot of times it is that trust, and do you like the person? Are you willing to open up and share your personal details with this person and talk to them for hours on end several times a year for the next several years, if not decades of your life? Do you genuinely like talking to this person, and do you trust them? And do they make your life easier? Do they make your life better? Do they make you happier? Those are things to look for in an advisor. Are there anything that you suggest to people when they're looking for an advisor, looking for a financial planner?
Right. I think you hammered in on a few key things that are important for sure: understanding compensation and finding a good fit. And I think the way one might go about that is also you can have conversations, you can shop around. You don't, these aren't lifetime contracts, and you can try before you buy and things like that. You can get to know somebody by searching what they read or wrote about or recorded, and that can give you some insight on whether there's a good fit or not. And the good thing about what's happened lately is there's plenty of content out there for you to evaluate an individual and get a pretty good feeling before even having to pick up a phone, for example. So I definitely encourage the looking around aspect and the notion of kicking the tires a bit in terms of finding a good fit.
I like that. I love the idea of someone talking to multiple advisors and just determining who's the better fit for them. Because again, the technical parts, while they matter, a lot of people can do that pretty well. Kind of all the engines work pretty well when you're buying a car, but do you like leather seats and heated seats or air conditioned seats? Or does that part not matter? Would you rather kind of save the money? Do you need a car that can fit all your kids, or skis, or loading stuff in the back, or your dog? That kind of, your lifestyle matters so much that if you're going to test drive multiple cars to figure out which one fits for you, it makes sense to test drive different advisors to figure out which one fits for you.
Yeah, certainly. And it's probably important to understand that this decision is probably as big as that car, if not bigger. So it's probably well worth it.
I I do want to reiterate that point you made, where a good advisor isn't going to ask you for that huge lifetime commitment. That purchasing a car is going to be you're either taking out a loan or writing a big check. For an advisor, and this is one of those small differences between the fee only and the fee based, sometimes you can try them out and pay the fee for the time that you hire them, but you should be able to fire them just as easily. And if there's something that requires a big commitment or surrender, I would question that just a little bit more. Like, it requires a little bit more understanding of that individual person before you need to make that big financial commitment. Because again, you're paying for the advice and the planning, not necessarily for the product or strategy or investment.
Right. Yeah, I think that makes a very good point. And sometimes it's important to understand, are you looking for a product or are you looking for advice on that product? So that might help you gear into where to actually look. Meaning, if you're looking for a commodity, that's fine. But if you're looking for, just what to do, that's a different question.
That's a great point. There's a big difference between how much life insurance do I need to provide for my family if something happens to me, which would be a financial planning question, versus I know I need $1 million in life insurance. How do I get the best premium?
Right. And asking the former question to somebody specialized in the latter is tricky or might lead you astray.
Their answer is, oh, you need more.
Yeah, the answer is more.
Okay, so I think we've done a pretty good job of kind of talking about some of the tangible benefits of just how advisors help clients grow their net worth over time. Talk about some of the intangible benefits, that kind of peace of mind that clients have expressed by working with me and you. And then also those kind of life planning conversations of what's the life they actually want. Even if we got them all the money that they said they wanted, what do they do with the money to live the life they want? I like that.
Yeah, good stuff, Aaron. I enjoyed the conversation. I like the fact that even though you and I know the landscape and the different players involved, it's something that if you're not in the industry, it may not be clear how all of these different puzzle pieces of players in the financial industry fit together. So I think it was helpful to have this type of conversation.
I agree. Thank you for your time today, Trishul. I really appreciate it.
Thanks, Aaron. I enjoyed the conversation, and thanks everybody for listening. If you're enjoying these, do subscribe to our podcast, and talk to you again soon. Bye.
Bye. We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.